program is the active center.
Today, we're jumping into the very language of the market, stock orders. Think of these as the fundamental commands you absolutely have to know before you can buy or sell even a single share. So let's get right into it. Okay, so you've done your homework, you've picked a stock, you are ready to make your move, but how do you actually tell the market what you want to do? Well, it all comes down to giving the right instructions, what we call orders. At its heart, every single trade is just a transaction. Someone's selling, someone else is buying. Stock orders are just the language we use to make sure that transaction happens exactly the way we want it to. All right, here's our game plan. We'll start with what stock orders are, then dive into the three big ones you'll use all the time: market, limit, and stop loss. And finally, we'll put it all together into your personal trading toolkit. So, first things first, what exactly is a stock order? Well, the simplest way to think about it is that it's the specific command you give to your broker. And let's be really clear here. These are not suggestions. They are precise, they are binding instructions. Whether you want to buy this very second, or maybe you want to wait for a very specific price, or even build a safety net to protect you, the order is how you make that happen. Let's grab our first tool from the toolkit. If your number one priority is getting in or out of a stock as fast as humanly possible, then what you want is a market order. A market order is honestly the most straightforward one there is. It's basically you shouting, "Get me into this stock," or "Get me out right now at whatever the best price is." But that phrase, "best available," is super important. It means your order will fill at the going rate, and if the market's moving fast, you might see something called slippage. That's where the price you actually get is just a tiny bit different from the price you saw when you hit that button. So picture this. You hit buy for 10 shares of some stock. Boom. In a blink, the order is filled at the current market price. There's no waiting, no wondering if you'll get the shares. You're in. It's really that quick. But, you see, that speed comes at a cost. You're giving up control over the exact price. So what if the price is the only thing you care about? Well, for that, you need a completely different tool, the limit order. This one is all about control. With a limit order, you get to name your price. You're telling the market, look, I will only buy this stock if it drops to my price, or I'm only selling if it climbs to my price. The trade just plain won't happen unless your condition is met. Now, this is where people sometimes get tripped up, so let's be crystal clear. When you set a buy limit, you are setting the absolute maximum price you are willing to pay. For a sell limit, you're setting the absolute minimum price you'll accept. In either case, you're making sure you get your price, or maybe even a better one. So let's see how this plays out. Imagine you own a stock and you want to lock in a profit at, say, $65. You set a sell limit order for that price. Then you can just walk away. If and when the stock price finally climbs up to $65, your broker automatically makes the sale. You just locked in your profit without having to stare at the screen all day. But there's a little catch. Your limit order isn't going to sit there forever. If the market just never hits your target price, the order will simply expire, usually after about 60 or 90 days. So remember, with a limit order, you have price certainty, but execution is not guaranteed. Okay, we've talked about speed, and we've talked about control. Now let's talk about protection. This is where the stop loss order comes in. You should really think of this as your financial safety net. This order is purely about playing defense. A stop loss is an automated trigger you set up just for risk management. It just sits there, dormant, until a stock's price falls to a specific stop price you've chosen. The second it hits that price, your order instantly becomes a market order to sell, getting you out before things can get any worse. Let me walk you through a quick story. You buy a stock at $50. Nice. It climbs up to $60. To protect those gains, you place a stop-loss order at $55. Then, some bad news hits the company and the stock starts to tumble. The moment it touches $55, your order triggers and sells your shares automatically. You've protected your profit and avoided a much bigger loss. It's your escape hatch. And here's a key difference. Unlike a limit order that usually expires, a stop loss is typically set as good till canceled, or GTC. What that means is your safety net stays in place day after day, week after week, until it's either triggered by a price drop or you decide to go in and cancel it yourself.
Okay, so we've just looked at three really powerful tools. Now it's time to put them all together into your trading toolkit so we can see which tool is right for which job.
The big question is, which tool do you actually need? And the answer, of course, really depends on what your goal is for that one specific trade. Are you trying to get in quick, get an exact price, or get protected from a fall? This right here is the core trade-off. With a market order, you have a high certainty your trade will happen, but the price is uncertain. With a limit order, it's the opposite. You have high certainty on the price, but your trade might not happen at all. And with a stop loss, you're just prioritizing protection. The most important thing to get is that you can't have it all at once. You have to choose what matters most for every single trade. So let's wrap this up with the key takeaways. You use a market order when speed is everything. You use a limit order when the price is everything. And you use a stop loss when protection is everything. At the end of the day, knowing which tool to pull out of the toolkit for which job, that is the mark of a smart trader. So now you have the language to actually speak to the market. You have the tools to execute your strategy with real precision. So the only question left is, what's your first move going to be?